Okay, great. I hope everybody can hear me. Good morning, good afternoon, good evening, wherever you are. I guess everybody's tuning in from everywhere now that these things are virtual. I'm Chris Danley, your friendly neighborhood semiconductor analyst here at Citigroup. It's our pleasure to have our latest and greatest keynote from one of my top picks in the space. In fact, the stock I've had a buy on since 2012, I believe, which probably outlasts half the people's careers out there that are listening these days. Texas Instruments. So why do we like Texas Instruments so much? Simply put, it gets down to the best margin and earnings and free cash flow growth of any name that we cover. And I want to mention a very important note. If this is Hey guys, can you hear me okay?
I can hear you now, Chris.
You're back. Yeah.
Great. The lovely
Just got cut out again.
I agree.
in semiconductors. So it's a pleasure to have the CEO, Rich Templeton here. Rich, how are you doing down there?
I am doing terrific, Chris.
Great, thanks. So I'll get right into it. The topic on everybody's mind is COVID. By the way, for those of you out there that don't see me or Rich, this is an audio-only presentation, so it's kind of a shame that this is the first time I've worn a suit in months and you don't get to see me in it. But anyway, Rich, why don't you talk about the impacts from COVID to Texas Instruments, maybe go through the increased costs that you're incurring, and do you feel that this is having a long-term change in your business and your end markets? And we'll jump right in.
Yeah, Chris, I would describe it in general, and I joined the earnings call back in, I guess, April, and Dave and Raphael gave some updates in July during it, but I remain pleased with the way our team is handling things around the world. The good news is that the team was exceptionally well prepared in terms of we operate in a very virtual way even before with a lot of WebEx meetings, and we've got strong relationships built with the people, so the productivity of what we're able to get done on a global basis is very high. We continue to be doing, kind of business as usual because we had processes in place with how we were selling virtually, and I continue to have customer meetings. We just do them over WebEx or Zoom or whatever the tool of choice is. So navigating that all well. our global footprint of diversified manufacturing locations and having great business continuity or BCP plans have really rewarded us, as I think you saw even through the second quarter results, as we were able to keep things running even with a lot of the different restrictions that took place around the world. So pleased with how the team is navigating it. We've really kept our eye on the ball. And, you know, all of us, and I'm sure you've got the same feeling, we look forward to getting back to seeing people and working more closely together. But, you know, we also think there's things you can learn in terms of, can you travel more efficiently, meaning less, and in areas like that. But we look forward to getting back to a more usual business environment probably sometime in 2021. So far, so good.
Chris, we can't hear you.
Stand by, please.
Back.
He seems to have dropped. 1 second for
Okay.
him.
All right. Chris just sent me a note, said he's dialing in. His Zoom has crashed.
Okay.
He'll be in a second.
As soon as he connects, I'll
Okay.
bring him in. I'm dialing out to him. He accepted. Should be joining shortly. There we go. Hello, Chris. Can you hear us?
Hey guys, can you hear me?
There you are.
I can.
Okay, great. Sorry, Zoom doesn't like me, and we're on my cell phone, so I'm probably going to get logged off on this once or twice as well. At any rate, Rich, just to pick up with the last question, apologies that I logged out. Do you think that COVID is having any impact on your end markets, and in particular the automotive or the industrial end markets? Do you think that the automotive end market might be a little bit slower growing or faster growing, and the same thing with the industrial end market longer term as a result of COVID?
Yeah, you know, Chris, I think in general, and, you know, I think you've monitored and watched this, I think as you went through the July earnings calls, I think things were reasonably logical, meaning things that had work from home or remote learning drivers, be it personal electronics, were stronger, server/cloud stronger to handle capacity, automotive because you had North American, European plants taken down in late March and really just starting to come back up in June. And then within the industrial market, you could see the logical areas where, obviously a medical end market's going to do well, where, anything in the energy field or factory automation where you can't get people into plants to install stuff is going to be slower. So I think that all made, reasonable sense. My general guess over a 4 or 5 year period is that you're actually going to see secular trends accelerate. And so I think of things like electrification of vehicles. It's going to continue to move very strong and pull forward on that. I think you'll find companies actually going on an increasing basis to more semiconductors and electronics because they've got to make their equipment better and more differentiated and more unique. And those newer products get higher priority in terms of their products and their launches. So in general, I think it's going to look pretty much like we expected 3-4 years from now on when you think about COVID and impacts from COVID.
Great. And since you're one of the deans of the space and TI is so diversified, I'm going to ask you a few of the, sort of the big pressing issues in semis. The question I get asked the most is, we're in the middle of a pandemic and a recession, and yet semis are hitting new highs, or at least they were as of 3 or 4 business days ago. So what's your impression as to why have semis done so well despite all these economic headwinds this year?
Yeah, I think and I think time will have to sort a little bit of this out, and you watch this as much as anybody and have as good instinct. Some of it is you have to remember that we were coming off of a pretty modest 2019, because 2017 and 18 were pretty strong, and then things pulled back a little bit in 19. So the industry was due to do better in 2020, even though you had the pandemic hit early in the year. Second is, I think you're just seeing, as I commented before on implications of COVID, the things that our industry does and what we put electronics into to make people more productive has, if anything, accelerated through the pandemic. And that'll vary depending on end market, as I commented. So if you're looking for some of those reasons, that's there. I know you've written, David sent me some of your comments even before of, do you have customers being careful about not wanting to be exposed to supply chain limitations due to either the pandemic or even on a broader basis some of the trade implications? You'd be naive to say there's not some of that, but being able to quantify that is always difficult. The great news, and it's how I look at things, is in the near term we know how we're going to play this, which is make sure that we're operating the factories pretty strong. It's really, really served us well, and I think it'll continue to serve us well. And then in the, quote, longer term, think 2, 3, 4 years out, you can really count on trendline growth and make sure you've got the right capacity invested to be able to support that as well. And so that's what, we keep our eyes focused on, and we don't have to make the same decisions that you're trying to navigate or help investors through.
Yeah. And so if we look at your business as a whole, I mean, clearly some end markets are better and some end markets are still recovering. Does it feel like it's, exhibiting something close to a normal seasonal pattern? And then what are the big challenges these days? Is visibility still fairly limited? How about the broader business for TI?
Yeah, I think as long as you're careful about getting down and looking at the smaller sized end markets, I think they can make, quote, seasonal sense. But automotive is not seasonal, as you can well relate to in terms of, what it did slowing down and coming back up. So I think you've just got to be very careful putting high-level seasonal trends on numbers, and you've got to look at them at a more granular level. And then, I think they're making sense. I laugh at the visibility comment because, everybody talks in good markets about high visibility, and in bad markets they have none, but it's the same damn market. So I think we've got a reasonable sense of what our customers are trying to do. It doesn't mean we'll ever be able to predict it. It's why you heard us and saw us take the strategy that we described in April of keeping our optionality very high. And we've got the luxury, because of our product mix and our product diversity, that we can do that. And we can do that at actually a very, very low cost. And therefore, it puts us in a position to be most flexible. So we don't have to get it called precisely right. And that's a very nice thing. And as 10, 15 years ago, we didn't have that luxury, as we were much more dependent on high volume, single, concentrated customers, where you better get those mixes called pretty accurately. We're fortunately by design in a very different situation.
Yep. One other change in your business has been that you've been able to, take your inventory a little bit higher and move to this more of a consignment model. Can you just address, the high levels of inventory that TI has, how comfortable you feel with that? And is this a sign of things to come? Do you think you can, kind of run the business with, 150, 160 days of inventory going forward?
Yeah, I think in general that, and the best comparison, and again, you follow us for a long time, look at where we were 10, 15 years ago when you're doing essentially custom high volume parts. You better not be operating at those rates or you're going to be in trouble. And today we have the luxury of being able to do that. And it really puts us in a position where our customers gain great confidence, because we tell them, don't worry about giving us a great forecast. Just when you need something, we'll have it. And that ends up being, I think, a much better way to do business with customers. And they respond well to that. Now, in terms of what's the exact amount of inventory that we're going to need, Raphael and I have talked. I think, we do owe investors an update. We've got, this quote inventory range. We're above it right now. And I think what you see us doing is making good decisions, thinking like owners, not just being static and trying to adhere to some arbitrary metric. But we will probably get an update or updated thoughts on that, maybe the capital management call in February of 21 will give some insight into how we're thinking over time on that front. The good news is it's, because of the confidence in what we're building, you've just got extraordinarily low cost, and the carrying cost on it is small. The other thing that gets lost in that a little bit, and you suggested it even with the question, is we continue to bring much, much more of the inventory that used to be downstream in the channel onto our balance sheet. So the days on TI's balance sheet are a lot higher, but we look through the whole channel and try to make sense of that as well. So I think we've done a pretty thoughtful job, and we'll provide some better help about how to think about the appropriate inventory range, as I said, early next year.
Great. And then talking to another, unique topic, and one of the reasons why we like TI is your high margins and your free cash flow growth. I know you guys don't necessarily give out formal margin targets anymore, but maybe just touch on what would be the future drivers of free cash flow growth from here, given your margins are so high. Yeah,
it's to me, it really comes down to the same things that we've talked about over time. And much of it in some ways centers around the four competitive advantages that you hear from Dave and you hear from Raphael of, at the foundation, manufacturing and technology. Most visible or most recognized is our 300 millimeter wafer size analog manufacturing, then the breadth of our products, then the reach of our channel, then the benefits of diversity and longevity. And, in the side of that, you see this, growing mix of automotive and industrial and products that just live a long time, which, as you know, correlates quite well to increasing returns. So, what are the things that, continue to drive, either gross margins or free cash flow margins? It's more 300 millimeter, it's better execution, it's more efficiency, higher quality of product mix, higher quality of end markets, a number of the things that we've been doing over the past 10 years. Obviously, the amount of improvement that we can still get because we're just starting from a higher point is less, but I still think there's some things that we can do.
Yes, we like increasing returns here at Citi Research. Shifting gears to talk about another big issue in semis is the whole trade war with China and companies going on or off the preferred list. And starting with Huawei, can you just discuss the impact to your business from Huawei being put on the list? And then do you think that there are any other companies that could get banned as well?
Yeah, it's the simplest way to describe it is, and I think probably every company is going to do this, or at least I expect or hope, and that is we're going to comply with all the laws and all the rulings that come out, and we'll deal with them as they occur, and we will not try to predict what that's going to look like. Dave may have the Huawei numbers, but they've been a declining and reducing customer for us in general. But
right.
We'll deal with it and navigate it accordingly.
Yeah, and so Rich, you were one of the first, I think, at our conference a couple of years ago to talk about, this is going to be an increasing reality as far as this sort of Cold War or trade war between the U.S. and China. Is TI doing anything to prepare for this continued issue to pop up between the two? Can you do anything to, better prepare the company for it, or is it just kind of, take it as it goes?
Well, if I recall, and I think I recall the discussion, and I had it, both at the conference because I had spent time talking about it internally, was to get everybody, expecting that this is a way of life going forward, not will the next trade negotiation resolve things, because I never expected it would. I just think it's going to, be a growing reality. And now the companies that adapt and adjust and deal with it best are going to be the ones that cope with it accordingly. And so, I think we've had, good efforts by our team to understand, the customers are still the customers in China, even with tensions and even with, any inclination of nationalism and preferences of where to buy. Our job is still to, come to them with the most appealing offers and most competitive offers and help them and help their business. And that's where we keep our teams focused right now. So I think that's the right way to approach it. And is it going to be an issue that, I think continues to grow? It probably will. But, we just have to be, it's not just happening to TI, it's happening across the industry, and we've got to just handle it better than anybody else.
Yep. And then another, maybe it's a related topic on that we're starting to hear more and more about, I'm starting to get more and more questions about, is the possibility or the potential for the U.S. government to begin to subsidize the semiconductor industry, either parts of it or companies. Has this ever come up with you? Do you think that this is possible? Is this a good thing? Is it a bad thing? Is this just fake news out there? What do you think of that topic?
Yeah, I'm careful because I think there's a lot of different stories that you hear, and obviously, there's some proposed legislation and activities that are taking place. I go back to, the things that we support, the things that, when I spend time with the folks in D.C., is really to make the U.S., headquartered semiconductor companies and semiconductor industry, strong for the next 10, 20, and 30 years. And I think the things that can be, best done on that are making sure you're investing in the long-term research and making sure that we have access to great people And then finally, make sure you've got, competitive tax structure so you can run manufacturing in the U.S. And, we've made progress on some of that over the past 4 years. We've gone backwards on some of it. And I think there's a growing, awareness in Washington that having had, a significant percent of the global semiconductor market is a good thing. And so I think people are trying to figure out just what that means and what are the right ways to be able to do that. We've seen, go back to the 80s, we've seen the Semitex invested in to make sure that we were doing well against the growth of the Japanese competition. And so I think we'll just have to find what the right balance of things are for this current phase.
Yeah, one question I got on that note from an investor as it relates to 300 millimeter. So, you are doing your 300 millimeter manufacturing at home in Dallas. Your competitors outsource that to TSMC. Could you just talk about the, sort of the puts and takes of doing it internally, why you chose to do it internally versus using a foundry like your competitors?
Yeah, I think it's just really simple math. And that is that when you've got your manufacturing internal and you run your manufacturing at world-class competitive levels, you end up with a cost advantage and you end up with better control of your supply chains. And so, to me, that is the only way when you operate, a 10 billion plus semiconductor company, we're doing, pick a number, 40 billion units a year when you look at your how you manufacture. And to me, COVID-19 was a perfect example of what TI can do because of the way we're structured with it internally. Not only do you get cost advantage, but we performed, I think, better than the majority of our competitors that were highly outsourced around the world, or they had very concentrated, test facilities. So I think we're just going to get growing advantages of that internal manufacturing and technology. 300 millimeters, just kind of the most visible example of the advantage we have, and we're gonna keep building that advantage, leveraging it, and I think it's going to serve us quite well. Put aside, do you have supply chain risks of stuff built in Taiwan over a 5 or 10 year period? That's even beyond that question.
Yep. And then another competitive question is, two of your biggest competitors are merging. Do you expect any change from that? And two of your biggest competitors just merged, I believe, 2 years ago. Have you seen any change, good or bad, or otherwise, from that merger?
Yeah, it's Chris, somewhat the question is, I think, a good way to frame it, because it's how people thought about it internally, even when that news came out just a couple of months back. We compete against those companies while they were standalone, and when they're put together, you're competing with them together. They just have one name above them. And so, nothing magical occurred, nothing different happened. And, the biggest thing, and you and I have talked about this in the past, when companies are busy integrating and merging, they're not working on getting fundamentally or organically stronger. And what I love about what we've been doing over the past 5 years, and even beyond just the acquisition you're mentioning, the other acquisitions that took place, particularly in 16 and 17, we've been busy building, the company stronger organically. So more capabilities with TI.com, better product execution, more discipline internally of how we're executing. And, just look at the steady and continuous gains, particularly on the analog side, that you see us continue to achieve. And I do believe that in the end, that organic strength, or, that building the company stronger, is what really determines success in the long term, not have you combined things together to make a larger company. So we feel pretty good about where we are, and we feel pretty good about where we're going.
Mm-hmm. And, speaking as, the old COO, you have pretty intimate knowledge of your product lines. Are there any, you guys are pretty diversified, are there any products out there you see that you don't have that you would like to have?
There's really two answers to that. At the high level, if you think about, the kind of major product categories, go down a level or two inside of analog or a level or two inside of embedded, and, you put 8 or 10 boxes across the page representing the next level of granularity, we've got check marks in all of them. And so we're in solid position, and there's just nothing we have to go get. As we've already discussed on, quote, scale and size, we can afford to do things that, our other competitors can't do. Running manufacturing, wafer fabs internally, the size of our sales force, what we're doing to transition and bring customers direct, those are all great benefits of our quote size and scale. But to the last part, if you go down far enough in the granularity of products, are there products that we don't have that, if there was ever the right match, we could possibly do something? Sure. We don't have something covering every space. We're not arrogant enough to think that. But the areas that we've got well covered, we're going to keep building them stronger.
Mm-hmm. And then on the M&A front, so you guys were fairly active from roughly 2000 to 2010 in terms of M&A. I mean, you really built up the analog business, but you haven't been active since 2010, and you've seen some other companies being a little more active. Has the reason you haven't done much since 2010, is it just pure valuation, or has you just felt like you had enough and you didn't need any more? Is it a combination of those? Maybe talk about why you haven't been as active in the last decade as you were in the previous decade.
Yeah, I'm careful on that characterization because I actually think the more accurate one that somebody had pointed out, go back and look at the Burr Browns and the Unitrodes. Those were really 2000, pre-2000. So it really wasn't the decade of the 2000s. It was, the end of the 90s where we thought there was really some, good capabilities that we wanted to bring in to help accelerate the growth of our analog business. If you look at what we did, and think of it as really 2009, 10, and 11, and you remember it well. I remember meeting with you, the morning that we announced the national deal in April of 11. Everybody on this call remember how, depressed everybody was about the economy in 2009, 10, and 11. They thought the sun was never going to come up again. And so we just used that as a great time to be more aggressive, be it picking up used wafer fab equipment, used wafer fabs, or eventually national. So valuations really made great sense. And now we've got, and I think you said it, we've got scale and we've got the capabilities. And oh, by the way, valuations are exceptionally high. It's just not a great time to be doing those things. You've heard me for a number of years, when you're buying things where the purchase price, or the free cash flow yield on purchase price is 3%. I know as an operator how to get 4 or 5 percentage points on top of that, but you're just not doing your owners over the long term any good when you're buying stuff at that level. So I just think discipline on allocating or where you spend your money really matters in the long term, and we're going to continue to stay disciplined on that front.
Yep, and you've been pretty forthright about we're just going to take our free cash flow after debt payback and go with a buyback versus a dividend split. What are your thoughts on how much to the buyback versus how much to the dividend these days? Maybe talk about how you've implemented that so far this year and going forward.
Yeah, I think it continues, and I think Raphael and Dave do a really nice job each February talking through during the capital management presentation just how we're thinking about that. We continue to get a lot of positive feedback from investors that presentation is really helpful for them. It's a good reminder and any updates that we provide. But basically the two things you'll see under, stock repurchase and dividends is on stock repurchase is to just really think like owners and make sure that when you're buying back the stock, you're doing it in very accretive ways for the owners for the long term. And, go back and look at what we've even done over the past 6 or 8 quarters. And now the grade on that you don't get for 10 years, but just tactically look at what we've done. And, you see large purchases in, I guess it was fourth quarter of 18. And then you saw us again pretty aggressive in first quarter of 20 and second quarter of 20. And I just think that thoughtfulness of, really bringing, being very disciplined about what levels you buy back at really add to the owners for the long term. And on dividends, I think dividends play a key role. I think they, allow us to attract a broader set of investors. And we think it's important to, provide that dividend, but also the ability for that dividend to grow. And I forget the exact data, but I think our, past 5 years and probably 10 years growth rate on the average on the dividend is probably sitting in the 20% growth rate, maybe a little north of that. And in the end, though, what this all comes back to is the comment you made, which is we've got to be great growers of free cash flow and disciplined of being focused on free cash flow per share, because then you've got the ability to then make decisions like stock repurchases or dividend increases.
Yeah, I think for the last 10 years it's averaged 22%, and for the last 5, 17%. But who's counting? One other topic I want to talk to you that's sort of TI specific is the move to a single distributor. I believe we're about 2/3 of the way through that. Can you just take us through, sort of why you consolidated the distribution system first? And I have a couple other questions on that.
Yeah, it gets a lot of attention on the in the near term, and I think you're close enough. We should have the transition mostly completed by the end of this year. But as you know, we've been on this journey for 5 and really 10 years. And, we believe the reach of our channel is a real asset. We think we do that work better. We think we get better results. I think you can see what we've been able to do with market share over time on that front. And I just think this is the kind of final piece to get that chapter completed to build closer direct relationships. And the goal is not to be direct. The goal is to grow your revenue faster by being direct. And I think we're going to be able to do that. But obviously, the proof on that will lie with how we perform in 2021 and 2022. But I think we're lining up to be able to do that well. And, as we touched on before, I think that's a very difficult thing for our competitors to do because they haven't built out the sales and applications team. They haven't built the systems and the processes in place. So that heavy lifting and that thoughtful work over the long term is really going to be a great asset to us.
Mm-hmm. A lot of people say that this will result in higher margins, but perhaps lower revenue growth. Do you think that that's true? Not true? Some? All of it? None?
Not true. I think the top goal of this of building closer direct relationships with customers is to grow faster. And so I think we're going to end up with greater market share and greater growth in terms of where revenue comes out. And we heard that same nonsense when we took distributors off of these design win registration programs. Oh, it was probably 5, 6 years ago now. And you've just watched us continue to power through that and gain. And this final act will be I think the same thing. Are there, potential margin lift? Obviously, when you've got fewer people stacking things up, there's less margin lift. It's not the reason we're going after it, but obviously if we gain margin through the process of doing that, we will certainly accept it. But revenue growth is what we'll really benefit from in the long term.
Yep. We only have a couple minutes left. I got 2 more topics I really want to touch on. Number one is the embedded business. You talk about your focus on free cash flow growth, and the embedded business continues to have lower growth and lower margins than your other businesses like analog, for example. Any thoughts, or why wouldn't you, get rid of it like you did with sensor and control, or spin it out, or do something like that? Why keep it?
Yeah, we will always, and I think the question is the great way to frame it. If we thought that the better thing for long-term free cash flow per share for the owners was to do something different, I think you've seen in our past we wouldn't be afraid to do that.
Exactly.
But the fact is, I think embedded is going to be a great contributor to our free cash flow per share growth over the next 10 years. We clearly had outperformed for 4 or 5 year stretch. We gave back some of that performance in 2018 and 19, but we've got work and effort underway, so I've got a lot of confidence. I'm going to guess we're not getting that question 3 or 4 years from now, and I think we're going to be very pleased with what it can do.
Great. And then last question. I'd be remiss if I didn't ask you about the sort of the succession plan of the replacement search. I think you had the shortest retirement this side of Michael Jordan in his prime. So what's the latest on succession plan, and how much longer you plan on hanging out?
Yeah, I refer to it as a brief sabbatical where Michael got to play baseball for a few years. But
you play golf, okay?
Yeah. It's really very simple, and that is that we are going to make sure that we've got a great answer for a 10 or 15 year shift, and I'll be here until we've got a good answer for that. I love the candidates and people that we've got leading the company inside. I think you've gotten a chance over the years to see the people that we have, and I believe they just keep getting better in terms of who we have growing up. You watched recently that we promoted Haviv Alan to the Chief Operating Officer role. He's just going to simply help us build the company stronger. When you get a chance to meet him, I think you'll see that intensity and that